Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the power of the Stockcharts platform. Our platform was launched about 25 years ago as a way to empower online investors in the late 90s to better understand the markets in the tech bubble. A lot of similarities, a lot of rhyming of the markets here in February 2024 with some of the patterns and some of the euphoric sentiment that I personally observed there in that period as I was just getting started in the industry. And what's so interesting is today we finally get that pullback that many have been talking about, and we just haven't seen. We've seen this relentless climb of the markets. The growth-oriented stocks continue to push higher. Today, taking a bit of a breather, all 11 S&P sectors in the red today. The S&P actually bounced a little bit going into the close, but overall still in a position of short-term weakness. So how can we differentiate a short-term pullback with something a little bigger? Well, I think that comes down to breadth conditions, looking to the left on the chart and identifying some key levels. Hopefully by the end of our show today, we will have answered some of those questions along with you using technical analysis tools. Let's get right to our market recap and focus on how the markets evolved on today's sort of day in the red for the markets. Before we get there, a very timely poll question. What's so funny about this is we create the polls weeks ago. Actually, end of January, I'm lining up polls for the month of February. Somehow I decided today was going to be the day we asked whether the S&P would finish February 2024 above or below the 5,000 level. I didn't really know at the time if the S&P would be near the 5,000 level, which it was. It was above there yesterday and below there today. We're almost 50-50 split, slightly more answering yes above 5,000 versus no below 5,000. I would have to go with the no's today. It would be funny if we asked that question tomorrow, right? Asked it after today's sell-off. I bet we would get a little more negativity than we observed there because we're asking that question as the S&P is closing above 5,000 for the first couple days ever. But I would say the weakness that we're experiencing today is part of a larger retrenchment that this market really has to go through, right? We can't have this, higher moves without meaningful drawdowns. That really, when you look back at bull market history of previous bull market cycles, you have to have those pullbacks, those higher lows, right? We can't have higher highs and higher lows without pullbacks that make those happen. I would argue we're probably in one of those here February into March. March low is pretty common in an election year, as we've mentioned many times. So I would argue today is sort of part of that broader experience we're probably going to be going through here in the next 6 to 8 weeks. Let's keep going with our market recap and look at how the markets played out. A nice sort of last 30-minute rally to the S&P 500, but still down about 1.4%. It was a rough day for risk assets overall, as we'll see as we go through. This is one of those days where we have a lot of charts to get to. The S&P finishing just about 49.53. The Nasdaq Composite was down 1.8%. Mid caps down 2.4%. Small caps getting crushed is a good way I would describe this one. Good verb to use. Down almost 3.6%. So pushing the downside. The only thing really in the green here is the VIX, which actually pushed higher. Now, not too long ago, kind of in that 3:30 time frame, it was up almost to 17. The VIX was up around 1670, 1680. Actually pulled back a little bit as stocks rallied into the close, but the VIX still above 15. So, again, general basic back of the envelope measures with the VIX. VIX below 20 is what I would label as a low volatility environment. VIX above 28 is a dangerous environment. VIX above 15 tells you we're kind of in that pullback mode, and anything below there, we're in a low volatility uptrend. So the fact that the VIX has spiked above 14 and now 15 today, I think puts us in pullback mode. Let's go to the other parts of the market. Of course, big news before the open today was the CPI number came out for January, a little higher than expected. And what that basically means is despite some Fed commentators sort of trying to play the other side of this with their verbiage today, I think the damage was done. Stronger economic data in terms of higher inflation basically suggests that the first rate cuts probably pushed down the road a little bit later in 2024 as opposed to earlier. At one point, they're talking about cutting rates as early as the March meeting. I think a number like you saw today in terms of higher inflation. Again, not end of the world inflation. It's still relatively low compared to the last couple of years, but suggests that the Fed probably going to wait a little bit longer, and that means higher rates for longer. And that usually doesn't mean good things for growth stocks. So interest rates all moving up You can see the 10-year yield up a full point, 0.4. So 432 is the 10-year yield. The 5-year yield right around the same time. The long bond yield almost to 4.5% today. Bond prices, of course, coming down as yields are going higher. So you had a sell-off in the fixed income markets. The dollar index up about 0.8%, coinciding with the sell-off in risk assets. Looking at commodities, sort of mixed here, but gold and silver really moving to the downside. Silver, the SLV was down about 2.7%, and gold, which has been sort of threatening all-time highs around $2,000, really $2,100 an ounce, coming off today about 1.4%. Crude oil prices actually slightly higher. Energy was one of the better sectors out of the 11, although, as I mentioned, all 11 S&P sectors finished in the red. Bitcoin moved lower and other cryptocurrencies as well. S&P sort of back below 5,000, Bitcoin back below 50,000. We can see that Bitcoin at the time we're here right after 4 p.m. Eastern, down about 0.5%. Ether prices down about 0.7%. And that's after a pretty nice rally here in the last hour. So as equity prices started to rebound going into the close, sort of a last hour, last ditch effort to regain some of those early losses, cryptocurrencies as well. So Bitcoin around 49,700. That 50,000 level is really that key level. I think it's a lot like S&P 5,000. Interesting, we're sort of right at similar big round numbers at the moment, but those are the levels I would be watching. I mentioned all 11 S&P sectors down. Healthcare, energy, industrials were your top performers. They were all down about 1% today. On the downside, consumer discretionary, REITs, technology, all down 1.7 to 2%. So two of those sectors, specifically consumer discretionary and technology, two of the largest sectors in the S&P 500, and certainly two of the growthiest sectors that I could list out for you, with communication services being the third of those. So two of the three FANG sectors are really pushing to the downside. That's why the NASDAQ underperforming the S&P today. That's why the S&P losing a lot of its previous strength here. As we look at a chart of the S&P 500, though, not the end of the world. I'll tell you one other thing I wanted to look at, though, the market trend model here. So I was talking with our development team, Grayson Rose and others here, about how we can improve this. This is our first iteration. This is version 1.0 of this market model visualization. Again, just a great visualization. I'm excited to have on the dashboard because it's a quick just check-in on where things are at. This is your cheat sheet for market trends, and we're looking at the stocks. So we're looking at large cap, mid cap, small cap, and the NASDAQ. You can see as of today's close, the short-term models for mid caps and small caps sort of right at that level. As we're processing this right around the close, as things are bouncing around, I wouldn't be surprised if things were bouncing around a little bit as we're sort of processing the official closes. But as things would start to get weak, I would be looking at that short-term model. The way that my market trend model looks at 3 different time frames. If things have been very strong, which they have been, and if they've been bullish across the board, which they have been, as things start to roll over, you would see the short-term model start to turn red, then the medium-term model, and then the long-term model. It would take quite a bit for the long-term model to turn. So the signs I would be looking for, literally the red flags, would be these models turning slightly negative. Looks like small caps and mid caps sort of right at the bubble of doing so as of today's close, as we're processing the end of day data. I don't officially change the model until Friday's close, so these are more intra-week signs of some weakness. I also want to point out just the Magnificent 7 stocks all in the red today. NVIDIA actually finished just narrowly in the red, although much of the day was spent in the green. You can see Tesla, Microsoft, Amazon all down over 2%. Looking at the S&P 500 here, this trend line, I was all about an hour ago. I'm starting to prep for the show, and I'm just, warming up my hands, sort of stretching out a little bit, looking at this trend line break. I'm ready to launch into all right, the trend line has now been broken. And sure enough, this market just continues to impress and frustrate and challenge our assumptions. Here's the S&P zoomed into this pullback, and you can see that we basically traded up to a new 52-week high on yesterday's close on an intraday basis, that is. Today we traded below that green trend line, but closed literally almost like a penny above that trend line support. So there's that trend line, and as I said, that trend line in green was made from the October low, connecting that to the mid-January low, which lines up really well with the late January low and lines up almost exactly with today's close. So we did trade below that trend line that I mentioned was a really important one. We didn't close below it, though. We actually closed back above it. So I would consider this trend line still holding until we get a valid close below there, which means tomorrow's session and maybe through the remainder of this week. pretty meaningful. I would tell you, though, when we do get a pullback like this, that is my signal to myself to update some Fibonacci levels. So I'm real time breaking down the chart here. I'm basically updating this Fibonacci relationship from the October low to now what appears to be, for now, the short-term peak from yesterday's action around 50.50. So with that as our October low, this is for now our February high. What are the levels? So if we would start to sell off here, a couple things that I think about. This trend line is your first warning sign, right? As long as we hold that, things aren't getting that bad. If we do break that, I would be immediately looking at the low, the most recent swing low, because an uptrend, higher highs and higher lows. So as long as we hold above 48.50 this week, that would still be a higher low. But if we break that, the 50-day moving average would be the next sort of level to pay attention to. That's currently around 4,800. Now, also note, now that we've reset these Fibonacci retracements, the first 38.2% level is right almost exactly at 4,700. That's literally the low end of this consolidation range here in December and in early January. So I would argue, I think this is just the beginning, as you've probably can assume based on the language I've been using talking about this market being very overextended. I think this is probably the beginning of a further retrenchment. I would say 4,700 is sort of my first initial downside target, just looking at the chart. We'll spend some more time with this one over time and see if we can update those levels. But I'm immediately saying, looking at the current bar and looking to the left, that seems like a really logical downside target based on Fibonacci support, based on the previous price support, that major consolidation that we had end of the fourth quarter, beginning of this year. Now, we have so many charts to go through. I'll try to hit on a couple of these. I would say with breadth conditions, earlier in the day, this actually almost just barely got below 50%. It might have done so, but by the close, it's around 54%. This is the percent of S&P stocks above their 50-day moving average. I think the market gods could hear me writing on a piece of paper, we broke below 50%, and they said, no, we will not give Dave that validation today. So we did close just above there. And what that tells you is literally in the last hour of trading, a bunch of S&P stocks were breaking below their 50-day moving average, but actually closed back above there. And that's actually kind of encouraging, which is why that 50% line is so meaningful to me. As long as we hold above 50% here, I would say this is still just a brief pullback within an uptrend. We get below 50%, all of a sudden it starts to look a little more like an August of 23, more like a February of 23. These are some longer drawdowns that took not just a day or two, but a couple weeks, if not an extended period of time like we saw in August. That's the beginning of a further pullback and a further reset. So that 50% line, not completely broken today, but really close. That's another breadth indicator I would certainly be watching here. Also want to talk about volatility, right? So the VIX spiked above 15, as I've mentioned here recently. The VIX for me is one of those red flag indicators. As long as the VIX remains low, as the S&P is in an uptrend, conditions are good. The VIX spikes, this is when you have to start thinking about what it means. Now, I'm giving you some generalizations, and I will tell you the market's never this ideal or perfect, but generally speaking, we've had a low volatility environment with the VIX in the low teens. Here's what I would look for. A VIX spikes above 15, which we did see today. That tells me pullback mode. The VIX spikes above 20. That tells me danger of a much broader decline or a much more meaningful pullback, maybe retesting some of those support levels from Q4. VIX spikes above 29, and that is you really need to get out of the way of this market and think way more defensively. So that's sort of the different shades of gray that I think, or shades of red, as it were, that the VIX could go through. I think we've had that initial pop, which tells you we are now in a pullback, and whether this is just a brief tactical pullback or something more significant, I think watching the VIX to see if it spikes above a level like 20 can be really helpful to try to differentiate something much more significant. But for now, again, still relatively low with the VIX now in the mid-teens. Let's look at some groups and names and see how they've played out with the market sell-off today. So semiconductors, the SMH, again, if you didn't know how rough today felt on just a one-day basis, I mean, the chart of the SMH is still quite good, right? The chart of NVIDIA is pretty good, right? And this actually almost finished the day still in positive range. So, again, you have to remember that we've had such a run that a pullback is still within a long-term uptrend. I think there's a lot of negativity that we would need to see from semiconductors to have this chart look anything but pretty strong, right? Higher highs, higher lows have been the story. The SMH above 185 would continue that pattern, so we can pull back another 15 points on the SMH and still be within an uptrend on that sort of short-term, medium-term time frame. With the pullback that we had, a lot of charts that were overbought up until today are no longer overbought. So I don't have a breadth indicator queued up of how many stocks are overbought. We could use our scan engine to kind of back into that, but I would say that the number today is a lot lower than the number it was yesterday. And that suggests, again, sort of plays into that tactical pullback read, just like we saw in November and December and January, not unreasonable to have a pullback to a higher low, and that's what actually makes this larger uptrend. So I think the SMH above 185 is still pretty good, but this tells me we're probably in that short-term pullback mode. Home builders are another group, and again, these are the two ETFs I've keyed in on a lot because I think the semiconductors are a great proxy for sort of the growth AI type of trade. I would say home builders are good for sort of like, not to generalize, but kind of like the other trade, right? The other sort of offensive names that tend to do well when the markets are in good shape. And so if you see weakness here, it tells you that sort of those other things outside of those growth leadership names are probably starting to struggle as well. Now, as we're doing the show yesterday, I remember looking at the ITB and thinking, all right, we've made higher highs December, January, February, and we've made lower peaks in momentum each one of those times. Today's drop, if nothing else, sort of solidifies the fact that we've made a new 52-week high on weaker momentum, right? And so every new high, December, January, February, the RSI has been getting lower and lower. This is a big monster bearish divergence, and I think this plays into some of the short-term weakness, the risk to further downside that we've been highlighting here on the show. So with ITB, I think it's a little clearer, right? Because we're right at the 50-day moving average. We're also right at the lows from January. That's right around $97 to $98 a share. And I think as long as that holds, this is just a brief pullback, maybe just an aberration, a quick reaction to CPI, and then things get better. But ITB breaks below 97. Those sorts of breakdowns happen, and some of the breadth indicators we mentioned before get more negative. This starts to look a lot more like a deeper drawdown. I'm expecting that. I'm not expecting a brief one-day pullback before resumption of the uptrend. I think this is something we're going to be dealing with over the next 6 to 8 weeks, if not more. And again, lines up with the seasonality almost perfectly. Let's finish off looking at some individual names. At the end of the show, during the show yesterday, we talked about some names that were reporting earnings. So these are a couple names that reported before the open today, I'm pretty sure. Shopify, number one, downside gap today, right? So trading down about 13%. We're closing just below the 50-day moving average. We are closing at the lows of the day. So think about what happened on the chart of Shopify. If we go to our chart styles, I'm going to do this one called Candle Focus. Just look at this candle here, right? So again, forget about the labeling of the candle and anything like that. Just look at what this means, right? We gapped down on earnings before the open. We opened around here, just below 78. During the day, Shopify was all the way up to around 83, 83.50. By the close, we're all the way down to 77 again. So we opened below the 50-day. We traded all the way up here, but by the close, we're right back down to the lows. Now, what's interesting is it's happening right at short-term support. So I wouldn't be surprised if this is a key level here, 76 to 77. We're kind of right there, which means as long as this holds, this is a nice sort of, again, just getting back to this range that we were in 6 weeks leading up to this little bounce here. But we failed to hold 76, and this is now failing to hold the 50-day, failing to hold the most recent swing low, and Shopify's a really ugly chart. That's the danger that I think we were trying to describe in the last week and really in the last month as charts like Shopify have just accelerated to the upside. That downside surprise can be pretty painful if you're caught on the wrong side of it. Note the bearish engulfing pattern that happened going into the close yesterday. Pretty good candle pattern to be watching there. And again, if you look at the intraday action on Shopify, this is what that candle pattern kind of looks like, right? We opened down here. You saw initial buying in the first 30 minutes of trading, but the rest of the day pretty much weaker. So this tells you, we gapped lower. Some investors thought, or traders thought, okay, great, I'm buying in. I'm getting a great company at a discount. Discounted from 89 down to 78, 79, $10 cheaper overnight. That's great. We bounced all the way up to the low 80s, but then all of a sudden, that initial buying power dries up. This is how an intraday, a short-term chart, relates to the candle chart, which relates to the longer-term trend. So hopefully a good example to think through if you're just getting started with this whole technical analysis thing. Just to finish off our market recap, Marriott, another one. We talked about the strength in the travel tourism trade. This one's down about 5.5 to 6% today. Again, traded higher going into the close. The 50-day moving average pretty nearby here at 228. But overall, I think this is initial pullback out of overbought conditions. I'd be concerned to see if it's able to hold that support. What concerns me about charts like Marriott or other names like Moody's, which is another earnings name today, MCO, actually closed right at the January low, so pulling back from 400, which is where we closed yesterday, around 370. So about a 30-point drop today. We gapped down below the 50-day moving average. No real buying power coming in. This is more deteriorating going into the close. This is completing that bearish momentum divergence of higher highs in price, lower peaks of momentum. So while we haven't really broken down too much, I don't see this as a bullish chart anymore. I think the bearish divergence is a red flag. Gapping lower like this is a real danger. I think we'd have to hold 370, which is right where we closed today. But if that doesn't happen, I'd be very concerned about further downside. A lot of other names here after the close we don't have time to go through, but names I'm watching: MGM, Airbnb, Robinhood, Lyft, Akamai Technologies, all reporting today's close. So while we're winding down with earnings season, still a lot of market moving potential, and some of those names you may be holding. So make sure you use our earnings calendar diligently during this period. That's it for our market recap. We're going to bring on today's guest, Sean McLaughlin of All-Star Charts, a fantastic guest, showing some ideas on the short side, actually, that he brought with us. Before we get to Sean's discussion, I want to make a couple quick announcements. First off, we welcome your feedback on our show. Particularly, we welcome your questions, and we'd encourage you to send us a question we can feature on the show. We're probably doing an all mailbag episode, I think, at the end of this week, and we'd love to feature one of your questions on our next mailbag episode. Email is the best way to get your questions in front of us, thefinalbar@stockcharts.com. We've had so many great comments on our YouTube videos, so keep them coming and drop a comment there, a question that you have that comes to mind as you're watching our episode today. We'll gather all those questions, hope to answer one of yours in our next mailbag episode. Also want to let you know, we would love to hear what you think about our show in particular. We have a survey running right now, and if you scan the QR code that we're showing on our screen, that would be fantastic, because what we can do is actually capture some of your thoughts about what we can do with the Final Bar and also with Stock Charts TV in general. We're actually redesigning our YouTube channel here at the beginning of 2024. Some shows are going to be rotating away. We're going to be rotating contributors into different shows as guests and feature some of their commentary in different forms. And we would love your feedback about how we can make the Final Bar a better, more useful use of your time every weekday after the close. So make sure you scan the QR code, answer a couple quick questions for you. It shouldn't take you longer than 5 or 10 minutes, and would really help us to make sure that we make this show as helpful as possible for you. I want to welcome on today's guest, Sean McLaughlin. Sean's the Chief Options Strategist at All-Star Charts, coming to us from Boulder, Colorado. Sean, good to see you again. Happy New Year. How are you?
Great. It's great to be here. Great to be seen. Thanks for having me on.
Yeah, no, it's a pleasure. And an interesting day to come on the show, as always, right? Sort of a choppy day. It felt like this relentless climb driven by the growth stocks. Today, a bit of a step back. How does a day like this sort of fit into your framework as you're trying to make sense of the markets here mid-February?
Well, David, we, as you know, have had a great run. When I say we, I mean everybody in the stock market has had a great run in Q4, starting in, early November.
Yeah.
The stock market, I mean, we just had liftoff, right? Lots of things moving higher. We at All-Star Charts, we participated as well. We had a lot of great long trades on, many of which we're still in. And that being said, over the past couple of weeks, I certainly was not turning bearish, but I'm certainly of the camp that it would not be surprising at all to see any kind of pullback. I'm not calling for a top in the market. I'm not getting bearish here by any means, but it would not be surprising at all to see a little bit of a pause, a little bit of give back on some of these really hot names that have taken off. Names like NVIDIA, right? I mean, they've just gone crazy. Semi or super micro stocks like that, just
Sure.
Unbelievable runs in the last few weeks. And I'd say we're due for a little bit of a pause.
How do you differentiate in your work? Obviously, you're looking at options primarily, I think, is the levers you're pulling. But how do you differentiate sort of a short-term, we're way over our skis, we need to lighten up, versus something that gets really negative, right? What is it that changes it? Is it a particular technical breakdown that you would see? Is it a breakdown of recent lows? Like what makes you sort of change your mind of, or differentiate, I guess, from a short term, nothing to be worried about versus something that's a little more meaningful?
Sure. Well, one of the many things that the analysts here at my shop pay a lot of attention to is relative strength.
Yeah.
And we also pay a lot of attention to the number of new highs that are hitting the 52-week high list or the all-time
Yeah.
high list versus the number of stocks hitting 1 month lows, 3 month lows, things like that. And one thing that my analysts have been noticing over the past month really is the number of new highs has been continuing to deteriorate. There's still stocks making highs on a regular basis, but the numbers are coming down noticeably. Now, the one thing that has not been showing up that at least gives me a little bit of pause is the number of new lows hasn't necessarily been rising at an alarming rate yet. That's something that we're paying close attention to, and if we see that, that will cause us to get at least cause me to get far more aggressively bullish or bearish. But for now, we're seeing a deterioration under the surface, right? The indexes have been making highs, and if you just look at the headline number, it's great, but something like more than 50% of stocks on the New York Stock Exchange are down for the year right now, which is kind of surprising and might be surprising to some who just look at the overall headline numbers every day.
Yeah, I feel like sometimes in my experience, and probably you've seen the same, sometimes sort of the movement in the market makes sense given what you're seeing with individual names and with breadth indicators and things like this. This is one of those times where there seems to be a disconnect, right? It's like the market's going up, certain stocks are going up, but there are a lot of things, as you mentioned, actually having a rough go of times here, early days of 2024. You brought some ideas with you, really thinking more on the short side. Can you talk to us about a couple of these? We're starting with, let's start with Lulu, which was one that you brought with us. Talk us through what this group of names is, what this, where you'd be looking here.
Sure. So I alluded a moment ago about how we are still in a lot of long positions that we've been in for 2-3 months now that have been working, and we're in some cases we're sitting on some really nice gains. So I'm not bearish here, but I do want to I'm looking at my portfolio as a whole and saying, all right, well, I'm a little bit overexposed on the long side. If we do have a meaningful rollover here in the markets, I've got a lot of open risk. So how can I mitigate that? Now, I see a lot of people on Twitter or X or whatever you call it, a lot of people trying to get short some of these high-flying names. And we joke, we call those the hero trades, right? There's lots of heroes out there trying to be the guy or the girl that shorted the hottest stock of the year at the highs and wrote it down. That's great if you can do that. Most people can't. If you can and it works for you, congratulations. But for me, the way I like to do it is I like to get short stocks that are already showing signs of topping, that have already been in a bit of a downtrend. And so I brought 4 names to talk about. And these are just examples, stocks that I've put some shorts on. There's more, but these are just good examples of stocks that, they were former leaders, but over the last 6 to 8 weeks, in one case even longer, these stocks have already started rolling over. And if the market does have a significant pullback from here, I think names like these will probably lead to the downside and will certainly offer a little ballast to my portfolio of all the longs that will be suffering in such an environment.
It's so interesting. Lulu is one of those that, I mean, coming off of an October low, incredibly strong fourth quarter, but compare this to an NVIDIA, which was a chart I had up a few moments ago. Lulu's the absolute opposite, right? I mean, having a nice downtrend in 2024. Is that what lets you think about something like Lulu on the downside? Just that rotation from sort of an uptrend phase to a downtrend phase? Or what sort of attracts you to a name like this? So, thinking more on the short side.
Yeah, I mean, for me, it's one of those where we keep it simple, right? Our mutual friend Brian Shannon always says only price pays, and in this case, the price has been going down. That to me is a very clear signal that this is already I'm not calling this a weak name, but it's weaker relative to the market. I mean, during this whole time that Lulu's been pulling back for the last 4 weeks, the stock market, the S&P 500 and the Nasdaq have been making all-time highs, right? So if it can't do well in that environment, then you see a broader rollover. I think this could lead more to the downside, and that's common theme with all these names here that I brought.
Yeah, let's go to the next one here. And you have a couple different sectors that you brought with you. Mosaic was the second one.
trying to give you a bunch of flavors, David. We're not
Yeah.
we don't just trade in the tech names or the retail names.
No, Mosaic's a different one, right? A specialty chemical name. And material stocks in general have not been particularly strong when you look overall. But Mosaic strikes me as one that's actually been in a pretty consistent downtrend for a longer period of time, but certainly year to date. Weakness as well. Does it concern you a name like this making a new 52-week low? As a check in the positive column or the negative column, or what does that mean?
You know, if you flip this chart upside down, right, this would be a stock that's breaking out to 52-week highs, and momentum traders, look at that, well done. Momentum traders love to buy breakouts like that, right? That's a classic breakout that any trend follower in the world would look at and say, oh yeah, I'm buying that. So why doesn't that work on the reverse side? Now, yes, shorts don't always go as cleanly down as longs will go up because there is a floor eventually, right? There is a zero.
Yeah.
And I'm certainly not saying the Mosaic's going to zero, but this is a trend that I don't want to fight. The trend is already established lower. Again, same story with Lulu. If it's not performing in an environment where most stocks are rising, then of course it should, at least in my mind, perform poorly if we really do get a calamity in the markets. Again, I'm not calling for a 20% crash or anything like that, but we could see a prolonged pullback, at least for a few months. I mean, seasonality would suggest something like that. That's pretty normal this time of year.
Yeah.
I think Mosaic could participate, and the trend is certainly working in our favor. I'm not one to argue with trends, David.
Thanks for the inverting the scale trick. That was a guy I wasn't even thinking about that. That was beautifully integrated into your comment. You know, DR Horton strikes me. Home builders are one of those groups that actually did quite well in the fourth quarter. And then sort of first quarter, they've been sort of sideways at best, right? And like the ITB, those home builder ETFs are kind of choppy and almost broke out, but now kind of back in there. But DR Horton's sort of testing the lower end is, with maybe this is an example. Can you just walk us through, if you're thinking of a name like this on the short side, what are the levels or what are the patterns that jump out to you as you're looking at a chart like this and thinking about how to structure kind of an options play on the downside?
Sure. Well, in the case of DR Horton, this is maybe a little bit different than the other ones. Yes, it struggled. I mean, it's been off of its highs now for about 2 weeks, or about a month and a half or so.
Yep.
But more to the point, and you hinted at it just a moment ago, the home building sector overall has been doing really, really well. And against that backdrop, DR Horton has been relatively struggling compared to its neighbors in the space, right? So if the space is going to roll over, if the stock market's going to roll over, DR Horton seems to be the worst performing, or amongst the worst performing in the sector. Just that's just another reason why, if I want to be short a name, that's the type of name I want to be short. It's already struggling relative to its peers. It should outperform to the lower end. And so for an options trade, what I did in this particular trade is I bought a put spread. I don't have the details in front of me. You caught me by surprise on that one, but I believe we're positioned in July options. We bought the 140 puts and sold the 120 puts.
Right.
Yeah, and so we can participate downside all the way down to 120 if we get that type of move. But it's a defined risk bet, and maybe I should have mentioned that earlier. When I like to get short stocks as an options trader, I have the luxury of being able to position in defined risk bets that if I'm wrong and a stock rips in my face, at least I know the maximum I could lose. Someone who's short stock can't necessarily say that. If somebody was short stock, like say Ecolab that had earnings last night and thing gapped up 10% today.
Yep.
Yeah, it doesn't matter where your stop loss was. You're getting filled at the opening price, which might be much higher than where you wanted to get out.
Yeah.
So with options, I kind of sometimes I tease and I call it a superpower, right? Like I have the superpower to define my risk, and that gives me the staying power. If a stock if a position is taking a little while to work for me, but at least I know that if I've sized my position in such a way that I'm comfortable suffering a 100% loss, which is totally possible when you buy a put spread, or if you just buy a call option or a put option, you could lose 100% of the premium. But if you size the position in a way that if you lost that 100%, it's just like any other loss, then that gives you a lot of strength to stay with those trends as long as the chart agrees with your position.
It's interesting. I know in technical analysis training, when you're learning it, you think a lot about risk and reward. I think with options, as you mentioned, you have the luxury or the superpower of actually clearly defining, here's my risk versus reward, and structuring it in a way that's pretty helpful. I think that's a really good point, Sean. One last question, then we'll have to wrap it up. But D.R. Horton is one of those earnings names. I mean, right before they report earnings, it's making a new 52-week high, and that was the beginning of sort of this period we're now sort of making sense of. When you're structuring things, and again, looking out a couple months with options, how do you think about earnings dates and what that might do to a stock? Is that something that you tend to avoid earnings names as much as possible, or is there a way that you think about the risk implied by an earnings that's a lot of times a binary outcome for these stocks?
Yeah, no, that's a really great question. And on my time frame, typically trades I put on, I'm positioning in options that are anywhere from 3 to 9 months to expiration. So in that type of time frame, inevitably you're going to be coming up against earnings reports. So obviously, one thing that helps is putting on those defined risk trades, right? Like knowing what my max risk is allows me to sit through those types of earning events. Now, generally speaking, if a stock has earnings coming up, within the week, I generally will not position that close to earnings event. But if earnings are 2 weeks out or a month out, I'm aware of it and I'll factor that into the strategy that I employ. But I won't necessarily let it keep me out of the trade, because in many times, David, you know this, if a stock is let's say it's a stock that's been in an uptrend and it's got earnings coming up, if there's a earnings surprises more often than not tend to happen in the direction of the underlying trend. Not always, certainly, but more often than not. And I would rather, let that work for me.
I love it. And thanks for talking through all those. You mentioned I caught you off guard a bit. People should know I abused you even more. I even prepped you with some ideas of what we would do, and then I went completely off script, but I knew you could handle it, Sean. And this was a lot of fun. I hope we can do this again, but thanks for coming on today.
I'm always pleased to come on your show, David. You guys do great work and you have a great team there. So keep it up, man.
Thanks, Sean. Good to see you. That's Sean McLaughlin. Sean's the Chief Options Strategist at Stockcharts. And again, I love having someone like Sean that we can actually just have a discussion and talk about some of these different real life things that happens. I think a lot of times we talk about sort of ideal setups, but then life is often very surprisingly different. So I think a great discussion about how to think about earnings, particularly now as we're winding down this first quarter earnings season. Been a lot of gaps to the upside and the downside, and just thinking about how to understand and quantify that downside risk, particularly if we see continued deterioration beyond what we've seen so far. Great take there, as always, by Sean McLaughlin of Stockcharts. Folks, we got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. So in our market recap, we talked about the S&P 500 again. I was initially thinking, all right, this is the day we break that trend line. This is after yesterday and the last couple of days really focusing on the importance of a trend line that lines up well with market lows. What's so interesting to me is we did trade below the trend line intraday, but we closed, for me, right at it. Now we're in like sort of a, splitting hairs about what exact angle we want. I don't think the markets are that perfect, and my trend line drawing is not that perfect either. So I see this as not yet validating a breakdown. I think the fact that we traded below but closed back above that trend line shows you there's some optimism in the last hour of trading, or at least some buying power. We'll see if that continues. So I think tomorrow's session, super important. That's Wednesday's session, to see if we're actually able to remain above this trend line support. Because a lot of times when you define a trend line or define a moving average or a support level, we'll trade below it intraday but close back above it. And that's not broken yet, right? You have to close through a key level. Then you actually need follow through as well to validate that breakdown. So breakdown not validated according to this trend line. Again, I think it will eventually. And I think this is probably the initial salvo of a much broader decline we're probably going to see for stocks because of all the reasons we've been describing on the way higher and the overextended nature of this market. But let's wait for the charts to signal that. Let's wait for that trend line to be broken. Not quite yet. Now, chart number 2, when I think about what gives me confidence to think that there might be more downside than what we've seen just today, it's charts like this. Here's the S&P 500 at the top, trending higher. Here's today's pullback, but overall, clearly in an uptrend over the last 3 months, undeniably so. Here's the percent of stocks above their 50-day moving average, from 90% down to just about 50% today at the close, pushing right back up to around 54%. This gets below 50%. That's a big-time red flag, because it tells you most stocks have now been unable to hold their 50-day. So watch that indicator through the remainder of this week. This next panel down is the bullish percent index on the S&P 500, the bullish percent index on the NASDAQ 100. These are two breadth indicators based on point and figure charts. For the 500 members of the S&P, for the 100 members of the NASDAQ 100, both of those now below 70%. And that's sort of that warning sign level that I look for. Finally, we have the VIX, and I've plotted it upside down just to sort of properly show that, a higher VIX tends to be coincided with higher VIX with weaker stocks. I flipped it over to show you that when the VIX actually goes up, it's actually more in line with weaker price action, right? So lower VIX, stronger stocks, stronger VIX, weaker stocks is sort of the relationship. So the S&P is holding up, but all the breadth indicators are sloping downwards. The VIX is starting to increase, meaning it's going down on the scale. And just look to the left around August of last year, and you can see why this is a very similar pattern to what we saw, right? Strength in the summer of last year. We even were stronger in July going into August, but all of a sudden, all these breadth indicators started to rotate lower. And when we started to get the bullish percent indexes below 70%, and we started to get the percent above their 50-day below 50%, those were the things that suggested that we were in more of a drawn-out decline, and that's what led to the September and October pullback of last year. Finally, some names reporting earnings, and I would say names like Shopify, like Akamai Technology, like Datadog, DDOG was another one. What's interesting about these three is they're all testing their 50-day moving average and or holding above it, right? Akamai at this point, sort of the most constructive. These are all charts reporting here either before the open today or after the close today. And I would say on these types of charts, especially around earnings, especially when the market starts to change its character, as I think we may be seeing starting with today's session, you look to see if names like this can hold their 50-day moving average. If Datadog and Akamai are holding an ascending 50-day moving average, if Shopify closes below its 50-day but is able to bounce above there tomorrow and we don't get that follow-through, these aren't bad charts. To the contrary, they're actually quite good charts because they have long-term uptrends and they're pulling back and testing short-term support. But that's why I would watch the 50-day moving average on names like the three I'm showing you here. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. A special thank you to Sean McLaughlin of All Star Charts joining us from Boulder, Colorado. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.